January is off to some volatility, and I want to cover something because I get asked a lot. Should I keep my money on the sidelines and wait until a dip or a crash happens? I'm going to help answer that in this video, and I'm also going to provide a lot of content that's going to help you come up with your own opinion about this and what you should do yourself. Before we get started, please subscribe to my channel. I provide a different opinion, set of knowledge and perspective, and it's just really good to do so, and that's going to help you in your investing journey yourself. So be sure to subscribe to my channel. Let's get started on this video. Let's look back at the last 2 years, 2020 and 2021. These were spectacular years when it comes to the stock market. That, that means that right now, valuations on a lot of companies are high, and this is leading to people predicting that in 2022 there's going to be a stock market crash. So let's first look at why 2020 and 2021 were so successful. Well, one, the Fed increased its asset purchases in the form of bonds, which injected a lot of money into the markets. Secondly, the Fed lowered rates to near zero, which allowed companies to borrow money at dirt cheap and individuals as well. And so a third thing is the government provided stimulus checks and a lot of other types of stimulus, which allowed people to get a lot more money and therefore spend more, prop the market up. They also postponed student loan payments and interest, so those payments that people were used to paying each month were no longer having to be paid. So I think a lot of that money shifted into going into the market. Unemployment benefits were at all-time highs, so if you were unemployed, you were getting a very rich amount of money each month in benefits. And I bet you a lot of people were spending that money, and that helped also prop the markets up. And then, of course, there was like special loans for small businesses, and that allowed them obviously to help their own businesses succeed and inject cash into the market. So a lot of things were positive in 2020 and 2021, which led to the stocks in the market increasing pretty drastically. But doomsday is being predicted every single day, but especially in 2022. And I want to cover those reasons now. For one, the Fed is is ending its asset purchases in first quarter 2022. So no more of that money will be injected into the market. Also, the Feds are going to raise rates 4 times this year is what they're saying, and that means that it'll become more expensive to borrow money. And so I think that'll make stocks less attractive and things like bonds and savings accounts more attractive, and that's where the money might go instead. Student loan payments are set to resume, I think, in May with the interest. And so when that hits, I think that'll create, a little bit of, volatility as well. Inflation is very high. I think it's like at a 40-year high. That's a huge thing right now. That's probably the main thing in 2022 why people are predicting a stock market crash. And then, of course, there's continued supply chain issues and shortages, which are leading to things like record used car prices, gas prices, so on and so forth. So these are the reasons why a lot of people are predicting the stock market is going to crash, as well as companies. A lot of companies are at all-time highs, so they just don't see that that can go any further. So now I'd like to kind of be devil's advocate to what's being said out there in the market and list some reasons why 2022 could be successful in the stock market. For one, it's expected that the virus will ease, and obviously this new one is less severe, and so by mid-year to late year, this could be a thing of the past. Of course, it will still be around, but not at the level it is, and this means more people will be going out and doing things, and there's no more lockdowns predicted. So that's a great thing for 2022. Another thing is the Fed is working hard to control inflation. And so if they can control it, level it off, and even start reducing it, that's going to create a very positive thing for the stock market. And then lastly, there are signs that the economy is recovering. Of course, unemployment keeps getting lowered every month. There's pent-up service demand, so people are dying to get out there and do things, and we see that with increasing vacations, so on and so forth. One thing I think people forget is a lot of companies have healthy balance sheets, a lot of corporations. And why? That's because of 2020 and 2021. So they're going into 2022 with very healthy balance sheets and cash flows. Also, the GDP has been very strong and it's been growing. So that's a great sign as well. So I think these things could lead to a very successful 2022 because people forget that these companies are still very healthy when it comes to their operations, their cash flow or their balance sheets. And so let's put this in my opinion. What's going, about 2022, shall we say? I think people are going to move out of those spec, SPAC, and penny investments and more into large quality companies. If you look at Oatly, they're down about 60% since they're, going public. You look at Robinhood, they're down 50%. As interest rates rise, people tend to be less risky with their investments. And so I think we're starting to see that kind of happen now that they're announcing these 4 rate hikes this next year. So I think you'll see a move towards more of the large quality companies. Also, I think more money will go into bonds because that's a guaranteed return by the government. And with rates raising, people will be more likely to put their money there. I think the same thing for high yield savings accounts, right? Those interest rates go up, people will be more happy to put their money in savings accounts, the high yield savings accounts. And then large companies will be less affected by the increase in interest rates and other negatives in the market because they have those strong balance sheets. They have that good cash flow. So think of Microsoft and Apple. Do you think people are really going to sell Microsoft and Apple? I don't think so. If anything, they'll be trimming off their positions, which I think we saw happen earlier this week, but I don't see people selling out of these completely. So I don't think we'll see, some huge correction with these large cap quality companies. I think if anything, you know, we're going to see a slowdown. And that's my opinion of 2022. I just think we'll see a slowdown of money entering the market, but as far as a crash or some type of dip, I'm not going to predict that because nobody can. And I'm going to tell you what the best thing to do is because in the beginning, I told you a lot of people ask me, should I keep my money on the sidelines? Well, before we look at this example, I want to just go over 2 risks of 2022, right? I think the 2 things that could send the market into a crash is if a new variant occurs that this vaccine can't handle. Because they're already, with Omicron, they're already preparing a vaccine for, I think, in 2 or 3 months to be released. But if a new variant comes along, that could send the market going down. Also, I think bigger yet, if the Fed can't control inflation, if all their efforts uh, don't really work, that will send the market down, in my opinion. So, should you keep your money on the sidelines instead of investing regularly and consistently? There's this fun example that I found out about maybe 2 years ago, and I want to share it with you because I think it's very important. I'm going to go over it at a high level, but be sure if you want to look at it in more detail, just look these things up. That's what creates your knowledge as well. And I just want to present this with you because I think it's an extremely, good example to show what happens in 3 different situations. So we have 3 different investors that we're going to cover their journey quickly and what happened at the end of their journey and how much money did they make. And so I don't know if you guys have heard of this, but there's an example with Tiffany, Brittany, and Sarah. So we're going to start with Tiffany. All right. So Tiffany, she is terrible at timing the market. So what she did was she saved 200 per month in a savings account, earning 3% interest, waiting for the perfect time to invest. She put this money aside in a savings account and she's waiting to put it in the market. So it turns out she puts the money in the market at the world's worst timing. She dumped all her savings into the market on the day before the fourth biggest market crashes. So all 4 crashes, she put the money in the day before, and then the market crashed the day after. But she never sold her stocks, she kept it in there. And even with her terrible timing, thanks to her buy and hold strategy, her investment turned from $96,000 into $663,594. So a very healthy and respectful, amount of money, despite her having the most terrible timing to invest her money. Uh, Now let's move to Brittany. Now, Brittany, she is pretty much, she has timing down. She can predict the market like no other. So she has the same scenario where she saves 200 per month in a savings account earning 3% interest and waits for the perfect time to buy. So as it turns out, Brittany is the world's best market timing. She has the world's best market timing, and she bought the day the market was the very lowest after each of the 4 crashes. 96,000 turned into $956,838, so almost $1 million. And this is her perfect timing. So very awesome, good for Brittany. I really wish I could time the market that well. But there's one thing that's even better, and that's Steady Sarah. So Sarah didn't have much interest in watching the market or trading. In fact, she only did one thing. On the day she opened her account in 1979, she set up a 200 per month auto investment in an index fund and never looked at her account again. Sarah made $1,386,429. And so this just shows, guys, that steady wins the race when it comes to the stock market. And I really, I think everyone's heard this phrase, but if you haven't, time in the market beats timing the market. If you invest regularly and consistently, you're going to be the steady Sarah that is most likely going to make more money than a perfect Brittany or a terrible Tiffany. And so I love this example. I think it's a great one for everyone just to keep in mind. And it just goes to show that when you invest regularly, it's the thing to do because nobody can predict the market. And there's something called compound interest, which is a beautiful thing. When you invest your money, you make interest on that. It grows. And then that interest becomes, you know, part of that pot, and then you make interest on the interest, and it just keeps on going and it becomes a snowball effect. And so, the power of compounding is important. So my advice is to just invest regularly. Don't keep your money on the sidelines because nobody can predict a dip or a crash. And for all we know, the market could go up another 20% this year. And do you really want to miss out on that 20% instead of investing regularly and making use of that compounding effect? Because once you invest, that money starts growing. So would you rather make, 10% on $10 or 10% on $1,000, right? The more you're in the market, the more you grow your money, the more you're going to make. And so my advice is to pick quality growth stocks with EPS upside potential. And that's the key to your positive performance. And so you look at companies like Microsoft. How often do they beat their earnings? Pretty much every single time. They're a quality company. They have a strong balance sheet. They have excellent cash flow. They just have a great moat. They have a good business model. You invest in companies like that and diverse across many companies and ETFs, you're setting yourself up for that Sarah situation where you're going to have a lot of growth in your money. Don't get caught up in these people that are predicting a stock market crash or following people that want you to invest in risky investments because that's a good way to lose money. Very few people are going to become extremely wealthy that way because it's like winning the lottery. It's not on your side and it's more likely you'll get struck by lightning. The better way is to invest your money regularly, and that's going to do you a lot of good. And if you look at my portfolio, I did a video of my year in performance, just 2 years of investing, I'm up 23% in my portfolio. That's because I'm diverse in quality stocks and high rated ETFs, and I invest regularly. I guarantee you, if I would have kept my money on the sidelines for most of those 2 years, I wouldn't have had near that performance. And so that's my advice. And just take all this from this video, put it into your own, context in your mind, and just think about it. It really is impossible to predict the market, and it's best to just stay in the market because that compound growth, that snowball effect is real. And year after year, you're going to see it happen. Just in 2 years, I'm seeing it happen, and it's a great feeling. So there's my advice with the volatility that's happening in 2022 is we don't know what's going to happen, right? A lot of people are predicting things every day, but the truth is nobody knows. Not even the best of the best can predict it. They're wrong all the time. The best thing to do is just smooth it out and invest regularly and ride the long-term growth of the stock market because it grows on average 10% per year. There's never been a time, a 20-year span where the stock market's been negative. And so I think the longest was in the NASDAQ. There's 15 years where it took for it to recoup. But if you're a long-term investor, you don't really need to worry about those things at all. Instead, just be diverse and you're going to do fine. So there's my spiel, and thank you guys for watching. And I'd love to hear your opinion on this because everyone has different, like I said, different knowledge set. And so if there's something you think that I'm really leaving out here that is key, please provide it in the comments. And I hope you guys have a great day. We'll see you next time on Mark's Finance and Fitness.